Okay, welcome to the latest edition of What's Up Monday. This is Dominic Chirichilla of DTN, and I'm happy to be with you. And I hope you have a successful trading week. Last week was a very, very interesting week. A lot of surprises. Not the OPEC increase in production, but the big surprise was the market reaction to it. And we'll talk more about that. If anybody has any questions, please feel free to email me at dominic.chirichilla@dtn.com. So with that, let's get started. And so where are we this morning? As of around 8:30 a.m., oil is off as we understood it to be off. The Saudi situation is what's driving the market lower right now. So we'll have to see, where we go from here. As I said before, equities are lower. The dollar is higher. That's being driven primarily from the turmoil coming from the European side of the equation. And it's going to be an interesting week. And again, a shortened trading week. Full trading today and tomorrow, shortened trading on no trading on Wednesday. Also, just as a point, this week's weekly inventory data will be delayed a week. The EIA will be reporting their inventory data on Thursday at 11 a.m. Eastern Time rather than Wednesday, and the EIA nat gas inventory report will be coming out on Friday at 10:30 a.m. instead of Thursday 10:30 a.m. all due to the fact that the government offices are closed on Wednesday. So look at the market. Look what happened. This is post OPEC. My goodness gracious. Who would have thought that we would have had this reaction? The vast majority of people in the market were pretty much positioning themselves over here, probably getting a little bit of short positions. The first couple of days has been of the market reaction has been probably short covering, followed by some new length coming into the market. And now today, we're getting a little bit of a capping issue here because of the conversations between President Trump and the King of Saudi Arabia. So we'll see where we go. Right now, the concern is, or the battle going on is there more oil being shut in from a geopolitical perspective rather than oil being increased? Saudi Arabia said they were going to increase production strongly right out of the gate in July. Well, it's July 2nd, and one would expect to see production going up. All of the freight monitoring systems will be reporting, and estimates should be coming out this week, so that's going to feed into the marketplace. Russia said that they were going to increase their 200,000 barrels a day in the month of July. So by the end of July, we should see a lot more oil coming into the marketplace, and if that oil turns out to be a greater volume than what we're losing, then we may start seeing the price of oil starting to come down here a little bit on the crude market. Again, you can see the crack spreads really are getting pounded. They're down to the lowest level in a long time. This is going to open up the eyes of the refinery, and refinery runs in the United States are well over 95%. So we could start seeing some pullback here a little bit, especially with refined product inventories building over the last several weeks. We look at that 5-year average and the max and the min, we're closer to the 5-year min right now. So again, we could get a bounce here. I mean, again, if we see crude oil coming off, I mean, we're not seeing a big reaction yet in the U.S. market. We'll have to see how the day goes. It's really just the early stages of it. But if crude does come off, we could see a bounce up. But if not, we may see some refiners starting to pull back here a little bit on refinery runs. Again, you can see that utilization rate. It's been sky high. It's well above maximum. I would expect, if nothing changes on the crude side, I would expect to see it start coming down and working its way towards the maximum. I think the refining sector is way ahead of itself from a seasonality point of view. You can see the normal seasonality evolving here, and the 5-year max level, or we're far exceeding the highest point of the 5-year max level, which normally occurs in early August. So very interesting, and one that suggests we're going to have ample supply of products in the marketplace. If we look at the diesel gasoline spread, in spite of the fact that diesel inventories are still below last year, below the 5-year average, and gasoline inventories are a little bit more in balance, we've seen the diesel spread break out to the downside for the first time. That's kind of put my eye towards going long gasoline, short diesel, but I want to make sure we hold here. This has only been 2 days, and there's been a lot of inconsistency in the market. There's been a lot of market movement based on emotions. Again, I hate to keep saying it, but driven back from the crude oil side of the equation. Again, this says the same thing. We're well above. Each week we set a new record for production, both on an annual basis and a monthly basis. As again, though, I see this as potentially the rate of increase slowing as we move down the road because of the bottleneck issues. Total combined inventories of crude oil and refined products did hit that 5-year average almost. We've kind of come off here the last couple of weeks. That's a positive for prices. That's supportive for prices. We'll see if that kind of turns around here anytime soon. Demand, in spite of prices hovering around $3 a gallon across the country for unleaded regular gasoline, we're still around the 5-year max level. Prices have come off a little bit. We'll see. Again, if prices continue to spike, at some point in time, there's going to be a level where we're going to see some elasticity of demand, and that's going to push prices down here, push demand down a little bit. But right now, yet, just enough to keep our eye on it. It's something we need to watch very, very closely. So is the adjusted OPEC accord working? Well, it depends on what you call working. If it's working, is it working and has it lowered prices? No, it's not working. Just the announcement of it has really had the opposite effect on prices. Today is really the first day, or yesterday was the first day of the month, and production should start increasing. So far, minimal reaction in the marketplace to the downside, and that also includes the conversations by President Trump and the King of Saudi Arabia. So it's the second week in a row. As I said last week, WTI alone rose by 8% on the week, and that added to the previous week's gains of around 3%. So market's up over 11% since the announcement of the OPEC adjustment. So very, very, very unpredictable, very surprise move in prices, and it kind of shows how deep the geopolitical risk is at a time when global inventories are now around the 5-year average, and in some locations like the United States, actually below the 5-year average. So it's got the market kind of very nervous here, and we'll see. I would not be surprised if the next thing, if we don't start seeing a subsidizing or a subsiding, I should say, in prices here in the near future, I would not be the least bit surprised to see President Trump start calling for the Strategic Petroleum Reserve to start sending some oil out into the marketplace to try to further add some downside pressure in prices right now. So let's keep our eyes on the ball here. This is not straightforward trading, and the market is going to be much more driven in the short term than it is going to be in long-term trends. Total combined stocks, after we had a pretty decent draw last week, are still around 156 million barrels below the February 2015 high, and about 19 million barrels below the 5-year average, but still 22 million barrels or so, 23 million barrels above the low hit in the United States here in April. As we said, OPEC is returning to 100%. That's a somewhat bearish, although the market hasn't called it bearish. And rigs have been topping. That's bearish. If U.S. production starts coming off here a little bit, what that means is we're going to see U.S. inventories basically starting to decline, and that would be supportive of the market. So we'll see where we're at here. Year on year, U.S. production is almost 20% above a year ago levels. Unbelievable. unbelievable movement in U.S. production here, and it just kind of has completely blown away OPEC, and it's really changed OPEC or changed that whole concept of OPEC really being able to control the market. They are not nearly the factor they used to be. So with that, I expect a very, very interesting, volatile week. Liquidity should be below normal. Again, remember, inventories are going to be delayed by a day for both crude oil, I should say in general, and natural gas. Watch the news headlines for Saudi Arabian comments, for President Trump comments. Be aware that we could see a Strategic Petroleum Reserve announcement here coming from President Trump at least. And the caution flag is flying. Be careful if you're on the long side. If you're still trading this thing from the long side, I would strongly recommend using tight trailing stops in your trading. So with that, if you have any questions, you can always email me, DominicChiricheller@dtn.com. I hope to hear from you. I hope you have a great week of trading. And for those in the United States, have a great holiday week and enjoy the day off on Wednesday.